of this impact. And having worked very closely with the African-American community in my world in Washington, D.C., after I left the industry, I think many of you know I started as a loan rep, actually. Somehow ended up in Washington sitting with the president. But the long meandering route there. But the challenge is that the African-American community always is very concerned that they're going to get essentially relegated to being, FHA only borrowers, and it shouldn't be that way. We have many of us grew up in a day when, Doug, it may overwhelm FHA again. FHA is already overwhelmed. They have terrible technology. It's a terrible bureaucracy that needs a lot of fixing. But and I was that commissioner, so I can say that. But this is all a challenge we face, right? We have a lot of really difficult housing issues that our nation is facing, and a lot of it's in the infrastructure bill. There's a lot of good stuff in that bill, frankly, that's gonna, if the bill goes through, that's housing related.
And not switching gears. So basically what you're saying right now, we're okay. We're going to be operating technically July 1st under the Credinger rule, while the patch is going to be extended by CFPB, but basically our Fannie Freddie is going to be under the Credinger rule, even though the CFPB hasn't recognized it and they want to relook at it and kick it down the road. That's basically what us loan originators, bottom line, are going to be operating under. You have two groups that have different opinions, but the Credinger rule is what we're going to operate under. The new rule as of July 1st until this is all figured out.
Yeah, and look, guys, FHFA, Mark Calabria has been terrible for our industry since he took the job. And this isn't a partisan point. I've known Mark for decades. I've testified with him in front of the House and the Senate on panels where we're both witnesses. I've worked with him on policy debates. But in this role, Mark is a libertarian who believes the government should not be backing. They should be backing as little as possible in the marketplace. He views the GSEs as the economic term is pro-cyclical, meaning they're not just counter-cyclical providers of capital, they're pro-cyclical, meaning they're crowding out private capital. So his goal has been to shrink them every step of the way. And I have written testimony on my computer that he gave in 2010, 2011, 2012, times when we testified together, where he gives prescription about how to shrink the GSEs, raise pricing on refis. 50 bips on your refis. Control second homes and vacation homes. That just came out, limited to 7%. And I assume most of you are seeing hits on pricing if you're trying to do those right now. And with this new PSPA, he implemented a whole bunch of capital standards. The proverbial analogy of the frog in the pot of water. If you threw a frog in a pot of boiling water, it would jump right out. But if you slowly turn up the heat, they boil to death. I mean, we go back to when the CARES Act first passed, no support for servicers on forbearances. First payment defaults, you're going to get charged 600 basis points delivery fee, and suddenly all that went wacko. People stopped doing refis, right? Overnight, then it slowly came back. The 50 basis point hit, adverse market hit on refis, which is ludicrous. It's not an adverse market hit. It's purely a way to slow refi activity at the GSEs and get more money in on those loans to help build capital. These are all just harmful to our marketplace, and the most recent moves are harmful as well. So this to me is, it's bad for housing, bad for mortgages. It doesn't have a lot of logic to it. So, there's a whole bunch of us who work actively inside the Beltway, and I'm not sure how much longer this will last, but for all of you, the good news is at least is you had an amazing year last year. You've had an awesome first quarter, and rates may rise a little bit, but the perspective for home buyer demand is incredible. So all of that is good. We just need more housing.
So yeah, speaking of that, you just touched before about Biden's housing plan. You want to touch on that real quickly of how that would help us? Speaking of maybe helping our inventories, we're coming along with this plan. What you see with that, how you see that affecting us in the industry?
Yeah, I mean, the infrastructure plan, and I'll tell you, I'm confident there'll be an infrastructure bill. It's going to, the bigger bill will go through the House. Then the real negotiation will take place in the Senate, and it'll all be about getting Joe Manchin from West Virginia to a point where he'll sign off on a piece of legislation. So it'll get a little more conservative. But at present, there's $10 billion for housing. And that doesn't include another down payment assistance piece, which is going to probably work its way in. That I've had the benefit of fortune to help on a little bit. But the bill, as an example, builds 100,000 new first housing units. It's got a ton of money for affordable housing, some affordable rental housing, some housing vouchers for renters. So stuff that won't necessarily help you as brokers,
Right.
but it'll help the housing system. And the 100,000 units will be big. The down payment assistance financing for first-time home buyers, first in a generation, which will be difficult to underwrite to own a home, it will likely be in there as well. But I'll tell you this, having been a guy who's worked in the Obama administration and worked very closely with the Bush administration. No president, I can't remember a president who came into office with a whole bunch of good stuff for housing legislatively. Clinton didn't do it. Bush didn't do it. Obama didn't do it. Obama came in, had to do a bunch of stuff on housing, but it wasn't necessarily
it's true. It's true.
what we pop champagne bottles over.
It's great. I think that's, and so the other thing is, where do you think, we spoke about the marketing, we are not talked about, where do you see the market going? How do you see it going for the broker industry, the wholesale channel? We've seen a tremendous growth last year in the wholesale channel. We've seen it moving forward. Right now, even we're selling houses are more than what I've ever seen. I've been in this business 33 years, some of the highest price going, but we're short of inventory. What do you see this year and how the market's going, where we're going for the wholesale channel, and how's the brokers are going to fare with that in this year?
Yeah, so let me start with a picture, okay? Just bear with me, guys. So this is the MBA forecast, and I'll tell you why this is relevant. The MBA is right between Fannie and Freddie, and Dr. Mike Frattantoni, who's one of the smartest PhD economists in the nation, is their economist. Mark Zandi, the chief economist from Moody's, has essentially the same forecast. So let's just look at where we're at. So look at 2020. I assume you can see this, right, Kimber?
Yes, can say it.
All right. So look at 2020. That was a big year, right? I mean, we had $2.4 trillion in refis, $1.5 trillion, 1.4 trillion in purchases, and the total was 3.8 trillion, making it the biggest mortgage year in history, right? Tied with 2003, essentially. So massive mortgage year. Congratulations, gang. I mean, great time to be in the business. The one industry that really killed it in a good way during the pandemic. And frankly, you helped a lot of America's economy, and you should feel good about that. I'm not sure making billionaires out of a bunch of independent mortgage banker CEOs was the best outcome, but nevertheless, it's just the nature of the Federal Reserve making sure we stoke this economy up, and the level of quantitative easing was just massive. But look at 2021. There's the forecast dropping from 3.8 to 3.1. That's the gray line. So forecasting a 700-ish billion drop, and that's not first quarter, right? Your first quarter was huge. So if you look at how this is going to look, I'm not going to give you the quarter by quarter forecast. You're really going to feel it in the second half of the year. And that's because rates are going to be up. Rates are going to be probably 3.4%-ish for a 30-year fixed rate loan running through the second half of the year. And so you see the impact. Look at the green and yellow lines in 2021. The green line actually goes up, green bar. That's purchases. It goes from 1.4 to 1.6. So, purchase activity going out through 2023, as you can see, that's the good story. Steady, stable purchase activity growth. If you're a purchase LO, and you've focused on that into the business, you're going to do pretty well. But refis are going to drop precipitously, right? 21 to 22, we're going to see refis drop by $1 trillion, and they're already going to start dropping here. You already know they're dropping. Rates are still pretty good, up a little bit from the low, but still there's some loans in the money. When it gets to 3.4% ish, 3.5, it's going to change the dynamics. And so what does that mean for all of you, for the industry? there's going to be winners and losers in this business. People who beat the streets and have realtor or builder relationships or referral partner relationships are frankly in a much better place than refi only centralized platforms. I mean, I'll tell this to the Dan Gilbert's face, but he's doing wholesale for a reason. I would not want to be a centralized call center refi shop, and that's what a lot of these platforms did over the last year. Even most of the major banks, the mega banks, Citi, and none of you do loans with Citi. Well, there's a reason for that. 96 or 95% of all their loans last year were refinances. Wells, B of A, Chase, they couldn't get out of their customers' way. They were just basically churning their own books and doing refinancing. They don't have LOs who are necessarily built right now to be high retail producers. And you know that. The average production of a non-bank loan officer is more than double that of a bank LO. And yeah, Joseph, I've got a whole presentation. I wasn't preparing that for Kimber because he wanted to talk about this one rule, but I've got a deck that I use for my clients. I'll send some of that to Kimber, and you can send that out, okay?
Great, thanks.
But I have a ton of data and slides that you can talk about the marketplace. Here's what you guys should think about is the merger that we saw yesterday with Calabria. That's just one of many. Stearns went through it. This is going to go on. And my own belief, and I think I know the CEOs of these companies. The CEO of Calabrese, Sanjiv Das, used to be the CEO of Citi. He tried to get me to come be president of his mortgage company many years ago. He's not running the new merged entity. It's being run out of the guys in Greenwich, Connecticut, who own the parent company who bought who bought Calabrese. And that's the same with Stearns and David Schneider, who's CEO of Stearns. He also used to be CEO of Citi, believe it or not, mortgage once upon a time. He isn't going to be the winner out of this merger. And when they talk about these merger announcements, you have to think, what's the objective? Because volumes are shrinking. The objective is to consolidate fixed expenses, offices, operation staff, secondary, servicing. You consolidate it, you riff the excess. 1 + 1 never makes 2 in a merger. It doesn't work that way. When you merge, you take the benefits of both companies and you try to keep as much of what's called the going concern in an acquisition, which is your production, keep that going, but you merge facilities and fixed expenses. And that's what's going to happen. And these companies are, I think, going to go through a lot of pain. I will also say this. I think companies that recently went public, that includes one of a big wholesaler who's been in the middle of a lot of these AIM NAMB wars and stuff, the silliness of the industry. But we'll see. They're going to have to really produce results for their shareholders. Quicken is part of that challenge. A lot of these big non-bank originators are owned by Wall Street firms, and their Wall Street investors are going to demand big things out of them. A lot of pressure is going to come on. And you guys, if you have experience prior to 2007 or 6, if you've been in this business 30 years, you've seen this before, but it's going to be a strange market. It's going to be very purchase dominated. Purchases are going to continue to grow. The home builders are going to be building more homes. We're going to see more inventory slowly coming to market to meet this extraordinary demand from millennials, which is totally driving all of this activity as they're in their peak buying years right now. But there's going to be desperation on some lenders who are doing their last pangs to survive, and there'll be price cutting, and there'll be ridiculous commissions being offered to come leave your job and go work for somebody else. I assume all of you are being recruited by somebody. And so all of that is going to be part of the market. And but I'll tell you this, it's more of a normal market, and we'll get through this. I'm telling everybody, and I'm coaching a bunch of branch managers who are producers right now for a couple of companies, and I meet with them. And I was an originator. I started as a loan rep, and was a top producer and ended up running branches and regions and all that stuff in my life, and ultimately big brand companies. And that's how I got into being a federal housing commissioner and stuff like that. But I did this job, and the reality is, stay focused on the stuff that your experts tell you to stay focused on. Activities based selling and reinventing your business is what's going to make the difference. So.
And do you think, and then we'll open up for questions, do you think that the broker channel is going to continue growing like it has? I mean, we know that it's been exploding because of refinances, but overall, do you think the broker channel is going to continue coming back and growing like it is and like it has grown? Maybe not as fast, but the growth that we've seen in the past 24 months of broker channel.
Yeah, I mean, look, the advantage of broker, and I ran wholesale for Wells when they did wholesale, the advantage of the broker business, in my view, is it's scalable, right? If you want to scale up volume, look what Quicken did. It's a classic case. They needed to scale up. They went big in broker, and you'll see that in a lot of companies. And that's good for you. I want as many people who are buying loans in the marketplace. And frankly, I would never pick sides, which is what the position I took. And even had our good friend Matt Ishbia call me on a Sunday a couple of weeks ago. And I was just very clear to him. I just don't think he's done a great thing, built a great company, but that's not how we succeed in this world. It's a competitive business. You guys are individual contractors, and your value proposition is you provide the best of choices to the consumer. And for people in the mortgage banking business who buy loans, you're cheap. I mean, you don't have to pay for your overhead, your brick and mortar, all of that. That cost doesn't get paid for by the wholesale lender. So I think there's great opportunity for brokers to grow. The challenge is going to be margin, and the broker margins are contracting right now, and it's getting very competitive, as you all know. And in many cases, you have to make the decision, and if it's an eighth out or 10 basis points out, and the borrower knows it, you've got to go the other way. And so that makes the margins continue to get crushed a little bit. So it's going to be just an interesting environment to say this. I really believe if you're a broker, your strategy has to be do not burn a single bridge on the investor side, because you have no idea who's going to be in or out of the wholesale business over the next 2 or 3 years. And some companies could even implode. Some companies that have grown too quickly, may find themselves under so much pressure and could end up in some difficult scenarios. I see some companies that I believe are overvaluing their servicing asset, and it won't take long for an accounting firm to come and take a look at that, and suddenly you're rewriting your balance sheet. Anything can cause. If any of you were around when Countrywide Mortgage ended. And they were once the largest wholesaler in the nation, that can happen to anybody. If you're old enough, you remember a company called Homeside out of Florida. Homeside once was as big as Countrywide. They ended overnight. Big, huge, large companies can exit the wholesale business. And so, my strategy would be, you're a great bottom line type of platform because you're not expensive, even though you absorb your own costs, but you're not at risk of firing yourself. And keep your investor pool. Don't pick sides. You have to at times for rate and service, but don't ever burn a bridge, because you're going to you don't know when the path is going to shift on you suddenly. And then invest everything. Don't listen to the negativity. Just focus solely on how you can do more business going forward. So I'm a big believer.
Great. I have a question. That was for you, David. Is over what estimated period of time might we actually see on the ground the impact of the 100,000 new housing units and the DPA funding for FHB included in the infrastructure bill?
Well, here's what, look, if you want me to walk you through sausage making of legislation in Washington, we'll take an hour. But let me
Grew up on a farm. Yeah, I know that.
Let's do the simple way. I expect that a House bill will get through by the July 4th break. That would be my expectation. And you got to think around sort of this calendar of Congress. But I bet by the July 4th recess, a House bill can get through. They have a significant majority, and so they just have to do the work and do the hearings and get it through. So that'll be the big House bill. I don't expect the Senate likely to take up a bill until, September at the earliest or October, and there's going to be a lot of working on that piece of legislation. The challenge of this bill is if it extends too far into next year, we're going to get into midterm season, and we call that the silly season in Washington. It's election time. Less impactful on the Senate side, depending on who's up for re-election. Very impactful on the House side because obviously you're up every 2 years in the House, and so the midterms are going to be crazy, particularly this midterm, and so that could stop activity going. So my sense is Senate takes it up by September. Better get it passed no later than January, at which point the first-time home buyer or the seller down payment assistance plan, that would probably be implemented pretty quickly. Just the rules have to be written by HUD, which would probably be the regulator, and then those rules have to be given to the down payment assistance providers of how to provide it, and then it gets rolled out. So figure 6 months after that. So again, down DPA out probably mid to late next year, assuming that timeline works. And we'll just have to keep it, I'm glad to talk to the brokers anytime. We can always just keep in touch and keep you updated on what's happening there.
Appreciate that. And what effect do you see on the people that are behind the mortgages? I know the CFPB is trying to put moratorium on it and slow things down. What effect on the housing market do you think they're going to actually do this moratorium? How much longer is it going to happen, or when are they going to allow the lenders to actually start making the people that can't pay to actually, go ahead and foreclose or get back in the market or sell, which I think there's been more selling than foreclosure with the equity.
Yeah. So, look, the Bureau put out, it's a proposed rule. They're going to make it final quickly. It's a quick post, but they're putting a foreclosure moratorium into the end of the year. I personally believe the Bureau stepped out over their toes here. It's inappropriate. We spent several years during the Obama years working with a lot of the same folks who are in this new administration, working on a national servicing standards rule, which provides specific waterfall instructions of how to take care of a borrower in distress. And the last thing a servicer wants to do is foreclose on a borrower. So I just think the Bureau got involved in actual contract agreements between servicers and their investors. I assume you're aware, but the GSEs have mandatory requirements at which point you must begin a foreclosure. So now they're going to have to adjust their policy theoretically. And I don't know about private investors. It's all very complicated in terms of how this why the Bureau did this. And I know the MBA is actively working in this comment period to try to make this a little less awkward. And my hope is this isn't a sign of what's to come out of this new CFPB. But I think it's the end of the year. Then what happens? You got a lot of debate going on right now with housers as to what's going to happen with these forbeared loans. And the only reason being, as we all know, it was optional, right? Back in April 1, when it went into effect, all you had to do is call, and you're in, boom. And by the time we're done, we will have gone through, year and 9 months, year and 8 months, year and 9 months on with some folks who had been in forbearance. That's a lot of negative equity tacked onto the back of your loan, right? We had negative equity in the Great Recession because home prices declined. This time home prices are up, but you also have huge balances for folks that volunteered. What really concerns me, what if someone volunteered for forbearance in the very beginning, didn't need to, but now they've been living payment free for a year and 9 months or a year and a half, whatever it is. And now they come back and they're looking at it and going, do I want to pay off that amount, or should I just dump the property or sell it? And the question is, do you have a year and a half worth of payments? You can do the math yourself in appreciation since you bought the home to sell it. And for a lot of people, they won't. So borrowers are going to have homeowners, and a lot of people are wondering where this is going to land. Some will say, I love my home. I want to keep it, and it's an obligation. I'm going to pay my loan. I'm going to pay this off over time, or they'll tack it on, as we all know, as a lien on the back end. They'll pay it off when the home sells someday down the road. That's cool. Some may still have equity out because they didn't forbear for too long. and they may have equity, but they still can't make their mortgage payments. They'll go to market, and that'll be some chunk of the business. And then there's going to be, some chunk of the business that forbeared for a long period of time. Whether they can or can't, it'll be either I can't pay it back or I don't want to, one way or the other. And I may not have the equity enough to sell it, and those will ultimately have to go to foreclosure. And most of those will be in the FHA program. The FHA right now has a serious delinquency rate of about 14%, which is high. It's about as high as it was during the Great Recession of 2008. And so we just have to see how that all plays out. And gang, I can send you analysis from brilliant economists and housing folks from Harvard Joint Center for Housing Studies and the Urban Institute and all over the place that have done analysis on what's going to happen here, and they all disagree. So, you probably know better. If you have borrowers who went into forbearance, you can tell me.
Right.
Talk to the borrowers that went into forbearance that you're aware of. Are they going to stay in the house when at the end? Or they have so much negative equity or forbeared, unpaid principal that it's just too much and they're going to walk? And, we've lived through this in a different way back in the Great Recession. It won't be anything as big as the Great Recession. For everybody, this terrible way of saying it, but it'll bring more inventory onto the market at minimum. So you should expect a slug of inventory early next year coming on. And we'll just have to see how the rest plays out. It's just a very interesting time, right?
It is. Thank you. Appreciate it. Anyone can unmute. We want to try to wrap this up. If you have any questions that haven't been asked that you would like to ask David, please do so. If you want to unmute and ask a question, we'd appreciate that. Appreciate David's time today. I do know here at NAMB, we're always here. We agree with choice. I think that's basically what he said today. And don't burn bridges. We've always agreed with that. And NAMB's always here for the broker, the member, the mortgage loan originator. We've always been on the Hill lobby, and I appreciate David's insight on this today. So any other questions?
Let me end with one thing for you guys, and then we can call it, Kimber. And again, if you ever want to reschedule down the road, I'm glad to do this every now and then. But
great.
You're about to have a absolutely on fire economy. The stimulus that we've thrown into this economy is absolutely ginormous. It's going to be massive. Job creation is already killing it. It's over 900,000 jobs last report. We're going to see that happening for quite a while here. And this is not going to go away quickly. Now, the Fed came out and said that Powell came out and said he's going to keep rates low. I want to tell you guys, that means keeping the Fed funds rate low. And what we're going to see is a yield curve. And we're already seeing it. The Treasury is 10 years at what, 160 today or 167, wherever it is. The yield curve is already widening. That's why you have rates around 3. You're going to see 30-year rates continue to rise. Not huge, but they're going to continue to rise. Low rates are the sign of a sick economy, right? When we have low interest rates that we've seen since 2008, literally over the past decade, are because the Fed jumped in 3 times during the Great Recession and did QE, quantitative easing, meaning they buy mortgage-backed securities, hold them on balance sheet. That creates a short in the market. There's a lack of supply of MBS in the marketplace. Demand still remains the same, and that drives prices up, yields down, everybody refis. So we had, QE1, QE2, QE3 during the Obama years in the Great Recession. Then rates actually did start to rise. The economy was recovering pre-pandemic. As we all know, even leading up to December or whatever before the pandemic, rates were already ticking back up again, right? Healthy economy. And that's really what should happen. Why is that happening? Because the Fed's no longer buying, and the Fed isn't going to buy. So when Powell says he's not tapering on keeping on Fed funds and buying short treasuries. The real question is, will he buy long MBS? And my bet, and a bet of most of us, is that they'll slow it at minimum, and that's where you'll see the effect of taking the biggest buyer of mortgage-backed securities out of the market. It's a supply and demand thing, right? So the demand shrinks because I took my biggest buyer of mortgage-backed securities out of the market. supply doesn't shrink proportionally. And so prices drop on the bonds, yields rise, right? So classic, capital markets, and that's just the way this stuff works. But you're going to have a really killer economy, which means you're going to have a lot of folks who can buy homes. Unemployment's going to drop precipitously. We're going to be back to full employment by third quarter of next year at the latest. And it's going to be driving upward. You're walking into summer, tourism, airlines, hotels, everything. Demand is going to be just huge. So you're going to have a bunch of qualified buyers, not enough homes. And so, this is where the challenge is going to come in. And your challenge is going to be really making sure the realtor thinks of you first, and that their buyer puts in a strong offer that's non-contingent, closing in 4.5 seconds to get the deal. And that'll make the difference. Yes, but it's going to be a great economy, and that we should applaud. The great housing year you guys had was on the back of a terrible pandemic recession. And I hate to say it, mortgage bankers do better in recessions, and it's not going to be quite as good, but it's going to be a really, really good economy.
And the last question that we asked was, do you have any thoughts on who might replace Calabria?
Yes, I do.
Okay. Would you like to share or no?
No, I would not like to share.
I didn't think so. I just want to ask the question that was asked. Dave, really appreciate it.
I do think the candidates.
Go ahead.
I do think that the candidates that they're likely looking at are folks that at least I know personally, and I'm expecting that whoever is picked for this job will be very pro-mortgage and pro-housing. So I expect that 50 bip refi fee gone shortly after this individual comes on, and the capital rule, which you haven't felt the impact of, it's going to raise G fees. I expect that to come off. And likewise, some of these things in this preferred stock purchase agreement are going to have to be negotiated. So it's a matter of time. It's a matter of time.
And the last thing for me is, what can NAMB do right now? Do you think it's important for us to do on the Hill? We have Roy, we have Mike here, our lobbyist. What should we be doing to help our members and going forward to get this all moving? Because there's seems like a lot of moving parts and what's important right now, in your opinion.
Well, look, Kimber, I mean, advocacy helps, right? And I go back to Mike Anderson, who you may remember as a former chair many years ago, who came to Washington all the time and was very effective. And I think the one thing you guys have done, NAMB, over these past few years is you haven't gotten into the mud, and you could have. And you've been playing this extraordinarily professionally. No one at the head of NAMB has been caught with terrible audio tapes. In the end of the day, I think, and I thought I loved Aim's passion, but I don't like unprofessional behavior in our business, because people view our industry, the finance industry in general, as a bit reckless. And when you work on commission for selling mortgages, you have a lot of folks looking over your shoulder. And I think the role you play is to be a really responsible, thoughtful voice. And Roy does a great job. And I think the most important thing is for all of you to be active. When there's a call to action or however you get people to write letters to Congress, do it. I actually think you guys should join the Mortgage Action Alliance of the MBA. 9 times out of 10, you're aligned completely. And call to actions are all automated, and it's free to join. But there's a lot of stuff going on right now where you need to remain vigilant. So, Kimber, I think you and your organization have done a good job being, respectful, good participants in the industry. And that's important for folks in DC that set policy. They'll listen to those that behave in a way they expect, as you walk around the hallways. Hey, good, Marvin. Thank you.
Thank you, everyone. Thank you for the comments. Thank you for appreciation for hosting today. Dave, thank you so much, and we do appreciate it. At NAMB, we've been there since 1973. We've actually doing it. Roy is amazing. He keeps us aligned with what's going on. and we are there. And I'll say this, if you're not a member of NAMB, I'm going to plug it, go to NAMB.org, please join. If you are a member, thank you. These are the type of things we do to keep you abreast, keep you informed. We'll take you up, Dave, and coming back again on this. This is amazing.
You better be a member of NAMB. How much does it cost to be a member of NAMB? Nothing? $50? $100?
150, nothing.
$150. If you don't give this group your voice with the money, that's absurd. That's the only way to make stuff happen. $150. I had members of my last trade association who paid $300,000 a year. So you should join.
Thank you again. Thank you, everyone. Have a great weekend. This will be recorded, so you can share it. It'll be there again for you. Again, thanks again, David. Thank you so much. Have a great day, everyone.
Great being with you.
Thanks.